All right, great. Hello, everyone. Thanks for joining us today. I'm Ritesh. I head the investment advisory team at Syfe. I'm joined in with Hayden, who is part of my team as well. Today's session is about Syfe, a broad introduction on how, who we are, what we do, and partly how our investment framework works for you. So feel free during the session to ask as many questions as you might have. This is really an introductory session, so Hayden will keep collecting all the questions as we cover the presentation. So feel free to keep chiming in, and as we progress through, I will take those questions as we progress. All right, great. So quickly, in terms of our history and team, Syfe was born in 2017. We are a Singapore headquartered company. We are licensed by MAS. We have a fund management license. First couple of years was basically spent just to make sure that our overall investment framework was in place. We had the right technology behind us, and we formally launched our platform in 2019. That was after the license came in as well. We launched with our global portfolios. Post that, we launched a slew of other offerings as well, including wealth experts, which provided you a little bit more of a human touch with respect to your investments as well. Post that, we have, more recently, post the pandemic, raised a significant Series A funding round. So that gives us, a fair amount of firepower to keep expanding and keep growing, and catering to the different needs that clients have with us as well. And most recently, as most of you might have seen as well, we launched our cash management portfolio last week, for which we have received an overwhelming response. And thank you so much for trusting us. And in our journey, I think we will continue to evolve and keep bringing you more and more smart solutions to look forward to. In terms of the executive team, our founder is Dhruv Arora. He comes with a huge amount of experience with respect to trading. Our core product, which is a global portfolio, was launched with the underlyings being ETFs. So he was the ETF trading desk head at UBS, and that's the expertise that he brings onto the table. Richard Ye is like a 30-year veteran in the financial services industry. He heads our portfolio construction and risk management team alongside Akiko, and Sebastian heads our distribution team, and I head the investment advisory team. So, these are just a few names, but essentially we are now a 50+ member team with people across different backgrounds. We have a very, very strong inclination towards technology, and our whole framework is built to be digital in nature. So we have a huge amount of very talented tech professionals as well. And they are really the backbone behind, what you see right now on our platform. Quickly touching on the operations and license, as I said, we have a retail fund management license from MAS. This is a very important slide to note because by virtue of this license, we are required to keep all client assets separate from our own assets. So even in a worst case scenario that something happens to Syfe as a company, because of the fact that client assets are kept separate in separate custody accounts, which is, HSBC and Citibank. And when you transfer money to us, the monies are received in a DBS trust account. So even in a worst case scenario, if something happens to us as a company, because these are held separately, we are not allowed to touch them and use them for our own purposes. So your assets are safeguarded because of, all the rules and regulations around the fund management license that we have. So again, this is a question that we get asked fairly often. So, very important to note that money that you invest through us is kept safeguarded. Now, quickly in terms of the different portfolio offerings, I think this is where we differentiate ourselves in terms of, the different platforms available and what they do for you. In our case, we are a very purpose-driven platform in the sense that what we want to do is everyone, when they're looking to invest or they're looking to do something with their money, there is a purpose behind it. So when it comes to, those different purposes, you can broadly categorize them as, either you want to save, right? Keep your money safe and secure, and you just want to earn better interest rate on that money, right? So that's your savings bucket. The second bucket is potentially an income bucket where you want to generate some sort of a passive income. And then the third bucket is usually a growth bucket where you want to, achieve different goals in your life. Some of them could be short term, some of them could be long term, and you want to grow your wealth to be able to achieve those goals as per your, investment horizon, your risk tolerance, your, individual capacity as well, right? So broadly, if you categorize these three different purposes that you want to solve for, that's where we think more from a purpose-driven standpoint as to, how can we make it easy for you to solve these different purposes, right? And that's where the different portfolios that we offer really fit into each one of these buckets. So when it comes to save, essentially you want to keep the money as liquid as possible, as safe as possible. And that's where our cash offering comes into play, because it is basically an alternative to having money in the savings account. Right now, the savings account interest rates have gone super low. And even if you do get some better interest rates at some banks, they come with like plenty of caveats that you need to have, your credit card spent to cross a certain amount, or you need to credit your salaries. So it comes with all those, ifs and buts for you to really hit those big interest rate numbers. And there's always like a cap on top that like, this is only applicable for the first, say $20,000 or $25,000. So we built the cash product in a way such that there is no limits, there is no ifs and buts, there is no asterisks, and it gives you a much better return on your portfolio without really taking too much risk on your, investment as well. So that's really the cash bucket, the savings bucket that you would want to have. Obviously, just doing savings potentially will not be enough to realize your long-term goals. And that's where the income and growth buckets come into play. So for the income and growth bucket, we have our Reits portfolio. The reason I classify Reits as both income and growth is because more of the younger investors, they invest into Reits more from a growth perspective. And a lot of our older investors invest into Reits more from a passive income perspective. And both are actually, possible in Reits because we have the option on our side where you can either reinvest the dividends that you get from the Reits portfolio, or you can take the dividends out as passive income. Now, the reason, people like to, invest into Reits is because Reits give a very high dividend yield. By nature of this product, Reits are required by law to give out 90% of their income as dividends. And what that means is they become a sustainable source of, continuous cash flow that you can receive from these investments, right? And that's why, like, as I said, people who are younger tend to, get the dividend, but they choose to reinvest the dividend back to the portfolio such that it can grow. But some of our older investors, they have already accumulated a lot of wealth, so their focus is more to, preserve the capital and generate some passive income on it. And that's where the REIT portfolio also comes into play to generate that passive income. Now, the last bucket is basically the growth bucket. So this is the bucket where you are actually solving for your long-term goals. And now within these long-term goals, there could be different investment horizons. There could be different risk appetite depending on each and every individual. And there could be like different financial capacity and other factors as well that determine what you want to do with it. So now within the growth bucket, we have the global portfolio and the equity 100 portfolio. So the global portfolio is basically a mix of equity, bond, and gold. And what this does for you is partly it's like a core allocation where it is diversified across asset classes, and you want to grow your wealth in a very steady and stable manner. That's where the global portfolio comes into play. And it has all those components of risk management, diversification, and choosing of different risk levels as well. The equity 100 on the other side is really a return maximization portfolio. So it acts as more like an alternative to you investing into the stock market directly, because when you try to do direct stock market investing, there is often emotions and biases that come into play. And there is always this element of whether you can do a good job about it or not, and whether you can get a sufficiently diversified equity portfolio that really optimizes your risk and return as well. So that's where the equity 100 portfolio comes into play, where we take away that headache that you don't need to track the market on a daily basis. You don't need to see, is this the good time to invest or not? We, invest into this portfolio, taking into account, what are the good things to invest into, and how can we generate long-term, returns for you and maximize those returns on a risk-adjusted basis, right? So that's where the equity 100 comes into play. So really important, just digest this slide. I think it is very important to mentally have a picture as to what is the purpose of each one of these different portfolios that we have in our platform. We also have risk levels that we have broadly, put in for each one of these portfolios. So as you can see, cash is supposed to be like really low risk. REITs and the global portfolio are somewhere moderate to, aggressive, depending on the risk level that you choose for the global portfolio. And equity is basically your high risk, high return kind of a portfolio. So now I'll quickly go into each one of these portfolios to give you a high level overview of what these portfolios are. I will stop after each portfolio so that we can take some questions as well. Hayden, I'm not sure if there are already some questions, but or we wait for each portfolio and then take them.
I think there's some questions that we can first answer with regards to the custodian accounts first, since we talked about that. So I think one of the viewers, they are asking actually for the custodian account, even though we have it in place, unfortunately, if Syfe ceases operations at a market low, are they actually forced to sell off, their assets at a low price, or what kind of resolution would there be for users at that point in time?
Well, that's a great question. So there are two possibilities that can emerge, and again, it is not likely that something will happen to us. I mean, we are very, very well funded, and that is something that you would have seen with our recent Series A funding round as well. But the point is, worst comes to worst, even in that scenario, there are, two options that the clients will get. And mostly, I think, out of the two options, the first options should be more likely. So the two options are, number one, if something happens to Syfe, given the size of our assets, most likely there will be another fund manager who will take over our assets. If that happens, then essentially on the client side, nothing needs to be done. It's just a change of fund manager. Your assets remain invested and you can continue with the platform, right, in general. The second option is where potentially we would ask you to liquidate because no one wants to take over our assets. Typically, that is a situation when your asset size is really small and it's just a huge operational burden for an asset manager to just take over your assets. So I sincerely believe that it is going to be the more former option, where potentially if something happens and if we decide to wind down or anything these unforeseen circumstances do play up, it will most likely be the case that another fund manager will be called in and you will be able to continue your investments. But even within these two options, your worst case scenario is that you might need to liquidate, right? That's your worst case scenario. Even in both these cases, it is not going to happen that your assets themselves are not safeguarded. So that's not going to happen. And even in case of, suppose you have to sell your assets, you can immediately take it out and redeploy, right? So it is highly unlikely that you take it out and redeploy, and within that there is a huge move. Very unlikely. So again, I mean, some of these are, I think, a little bit exaggerated when people show these concerns. But broadly, I think the regulations under which we operate, these should be very, very smooth in terms of how you will be able to redeem your assets, or how your assets will be transferred over if some new entity comes over.
Right. Thank you, Ritesh. And maybe we can take on one more question before we proceed to the offerings as well. So one of the users has also asked that, in terms of our portfolio offerings here, are they meant for kind of short-term investing, or are they meant for a medium to longer-term kind of investing strategy?
Right. So definitely medium to long-term. We don't, we are not a brokerage platform. We are not a, platform where there is a menu item and you go in and go out. It is not intended to be that. And that's why, if you look at from a broad level perspective, I bucketed all of these to be purpose-driven investments. These are goal-based investments. You're really investing to solve a particular goal. Now, it is possible that you have a short-term goal or a medium-term goal or a long-term goal. And depending on that, there are options available on our platform to invest, right? So for example, within the global portfolio, and I'll cover this later, there are 11 different risk options. So if it is a 1-2 year goal, which is considered short-term, you can go for a very low-risk portfolio on the global side, or you can go for a risk-managed REIT portfolio. That's something that we also have on offer. or if you want some money that needs to be, there, say 5 months, 6 months from now, that the cash plus portfolio can be a good vehicle for you to park your assets and really earn some interest on it rather than just lying in the bank account doing nothing, right? So those are the ways that I would think about it. I wouldn't use them as trading portfolios. So that's definitely not the intent.
Right. Thank you, Ritesh. I think some of the questions can be answered or will be answered along the way as we explain the portfolios. So I think we can actually move to the portfolio offerings.
All right, great. So as I have mentioned over here, let's go one by one. So let's go on the savings bucket. So the Syfe Cashless Portfolio. This is the portfolio that we launched last week. As you've seen through our different promotions and all as well, the current projected yield of the portfolio is 1.75%. The portfolio invests in very liquid money market and short duration, high quality instruments. And essentially they are very short duration in nature. And by virtue of that, essentially, the quality, the high quality and the short duration nature of these products basically mean that they are fairly low risk in nature, right? The difference between a cashless portfolio and a typical savings account or bank account or like other places is, there is no lock-in. There is daily accrual of returns. So typically other interest-bearing accounts, they credit your interest on a monthly basis or a quarterly basis. In our portfolios, you will see the returns actually accrue on a daily basis. There are a lot of features that we have built on top of this cashless portfolio as well, where essentially you can first transfer your, sort of cash which is idle into the cashless portfolio, start earning some interest on it, and then subsequently, you can transfer money from this portfolio to our investment portfolios as well, right? There is a feature of automatic, DCA or recurring transfers that you might want to do from your cash portfolio to the other portfolios. That feature is going to come in a couple of, months time, I guess. So definitely you can do much more as we, enhance this product. There is no minimum investments. There is no limit. So there are no gimmicks as such that, this is only, valid for the first 10,000, 20,000, nothing like that. You can put in $1 million and we will still, invest it in a way such that we can generate a projected yield of 1.75%. There is no lockup of your money. And again, you can take out your money or withdraw or transfer at any point of time without any questions. So quickly, I think in terms of what does the Syfe Cash Plus portfolio invest into, it primarily invests into these 3 funds. And if I were to bucket them, they are, money market, ultra short duration and short duration, right? So these are the 3 buckets that we have created for your cash plus investments. And again, the reason and the way that we have constructed this portfolio is to make sure that, you get a decent amount of yield without really taking, too much risk with your cash, right? Because at the end of the day, it's your, hard-earned cash and you want it to be safe and liquid and, you don't want too much fluctuation with it. So the way that we have constructed the portfolio, where essentially we do take a little bit of a risk with the 35% allocation to the short duration bond fund, but that is sort of very well managed because of the bigger allocation to the money market and the enhanced liquidity funds, which are more like money market instruments. So at the end of the day, the short duration bond fund really helps you to juice up the return on your cash without really increasing the risk of your portfolio too much to be worried about. Now, how do we come up with this 1.75% projected return, right? The underlying funds that we are using are these Lion Global funds, which again, project a gross return of 1.8%. Now, one thing to note is, some people ask us this question that why can't we just go and buy these funds directly by ourselves rather than through Syfe, right? And that's where the power of Syfe comes into play, because number one, for retail clients, you will only be able to subscribe to the retail share class of these funds, which are supposed to be much more expensive. The fund level fee of the institutional share class of these funds that we subscribe to, the total expense ratio, so this includes management fee plus other expenses, is 0.35%. If you go for the retail fund share class, you will be paying a much higher fee than this. Plus, on top of this, because of our relationship with the Lion Global managers, we do get some rebates from them. And our promise to you is that 100% of those rebates are passed back to you. So we don't earn anything from Lion Global. So we are not incentivized by them to, just use their products per se. And we are highly aligned to our clients that, any rebates that we receive, we will just pass on those to you full-fledged. And on top of that, we don't charge you any management fee. So this is a completely free product, right? Like, we don't charge any management fee on it. So overall, after accounting for all the rebates, the free management fee from Syfe standpoint, you get a net projected return of 1.75%, which I think is very, very attractive given the risk return trade-off that you're taking, the overall return that you're generating. And again, the fact that you cannot really, generate this net return if you were to do it by yourself or through any other platform, right? Because of all the rebates and the institutional share class funds that we're subscribing to. Now, quickly, I think a comparison between the Syfe Cash Plus offering and some of the other platforms that do offer, similar cash offerings, right? So, it's a no-brainer when it comes to the savings bank account, like, the net yield, on a more aggregate basis and on a big lump sum basis is like 5 basis points. And then we have some of our, other platforms which do, tend to give you a little bit higher return. But if you look at Syfe Cash Plus, that's where, we stand out. We are right now pretty much at the top in terms of the projected yields that we are able to generate using your Cash Plus account. And again, there is no gimmick of, deposit requirements, and even like, the fact about like, how quickly funds get deposited and withdrawn, we are constantly working to optimize those as well. So you can look forward to more such, a simplicity to come into our, offering going forward too. So before I move on to the Reits portfolio, Hayden, just quickly pausing a bit to take questions on the cash portfolio.
Mm-hmm. So one of the users have actually asked for the Cash Plus portfolio. Are there any currency rate fees imposed, or is it purely in Sing dollar for the Cash Plus itself?
Any currency risk you mentioned?
Correct.
All right. So see, I think all these three funds, they invest with a fully hedged, exposure. So what that means is there might be, and most of the, bigger bonds that exist, they do have, USD denominated sort of, how do you say it? Like, USD denominated sort of, issues basically. And what that means is you do have some currency risk from that standpoint. But if you fully hedge that exposure back to Singapore dollar, then you don't need to worry about any currency risk. And broadly, if you look at the overall composition, the Singapore exposure is more like 50-60%. So, it is a very SGD kind of a portfolio, and the currency risk, if any, is fully hedged. So you don't need to worry about those.
And also, Ritesh, I think one of the other questions that came in was that we were talking about Saxo Bank being one of our custodians for the accounts here. So some users are wondering, what's the difference with investing with Syfe and, as compared to using the brokerage with Saxo Bank?
Right. No, so I think a good question. So again, the point here is that we are not a brokerage platform, right? So if you know what you want to buy and in what proportion to buy and, how to rebalance it and keep it optimized all the time, feel free to use the brokerage platforms. But then it is like a DIY strategy, right? Like you decide whether if you do well, then, you can pat yourself at the back. But if you don't do well, then you have yourself to blame. Versus in case of Syfe, as I said earlier as well, we are a goal-based platform. We are a purpose-driven platform. What that means is we pre-create these portfolios for you. And then you don't need to worry about like, is this a good time to invest in the market? Shall I buy this or shall I do that? You take the emotions and biases out of the equation and you invest with a goal in mind and according to your risk appetite, according to, what you want to achieve. And, the different options really help you think in a more structured manner, how to invest on a more consistent and, disciplined basis, right? So that's the whole beauty of investing with a platform like us, because it's a more actionable platform, right? You don't need to think, you just need to deploy. You just need to broadly understand why are you investing into this, right? And then you leave all the job to us and you're paying like a very small fee for us to manage your portfolio and do that hard work for you, right? So that's the way I would differentiate a brokerage platform or Saxo or any other, platform per se versus Syfe.
Right. Thank you, Ritesh. I think the other questions will we can actually answer them after the next few portfolios as well.
All right, great. So just quickly, going back to our offerings. So let's focus on the second bucket, which is the Reits bucket. And broadly, again, from a purpose standpoint or objective standpoint, it's an income plus growth bucket that we are targeting, right? So the Syfe REIT Plus portfolio, this is actually one of our most popular portfolios. The more popular, the more sort of used portfolios as well. And why is that the case? Is mainly because of a few aspects. It is a very unique offering. We have actually tied up with the Singapore Stock Exchange, and they actually have allowed us to use their REIT index, which is called the IHS REIT Leaders Index. This index basically tracks the largest and the most liquid REITs listed on the Singapore Stock Exchange. So by virtue of you sort of investing into the Syfe REIT Plus portfolio, you are getting access to the most liquid and largest REITs that are listed on the Singapore Stock Exchange, right? Also, by virtue of this portfolio, you are building a very diversified exposure to the REITs market in Singapore, because when you, again, you can actually buy the individual REITs yourself by going to a broker and doing it yourself. But you will run into a lot of issues. Brokerage costs, you will, not be able to optimize. If a dividend comes, you want to reinvest it, you will get slapped with a minimum brokerage cost. So there are a lot of benefits more from the standpoint of saving cost, why you should invest into the REIT Plus portfolio. But more than that, it's a very diversified portfolio. It is across, the sub-segments as well. It is not just into office and retail malls, which have been a little bit more challenged over the last 1 year or so. It also invests into data centers, healthcare, logistics, industrials, and all of these REIT subsectors, which have done really well over the last year as well. And they continue to, do well going forward as well, right? Now, I think some of the attractive features of why REITs are liked by Singaporeans and in this part of the world is because of their attractive dividend yield. So in 2019, it gave 5.1% dividend yield. In the current low interest rate environment, I think anything, 4-5% dividend yield is very, very attractive. And given that REITs actually, are listed on the stock market, they also appreciate in price, right? So that's why I categorize REITs to be, your investment where you can generate a passive income. But if you reinvest the dividends, you can also get a good amount of growth with your REIT investments. I think one more, key point that I want to highlight before I move ahead is that REITs as an asset class, and given that this portfolio is just a SGD portfolio, so we only invest into those REITs that are listed on the Singapore Stock Exchange and they are SGD denominated. So again, this makes sure that you don't have any currency risk. And I'll come more to this later on as well, where the global and the equity 100 portfolio, the growth portfolios that we'll talk about, they are underlying USD denominated, right? So they do expose you to some currency fluctuations, and if USD continues to appreciate, some of your portfolio returns might get dampened because of that. Versus in this one, it's a local portfolio, it's a Singapore dollar portfolio. You don't have any currency risk, and you can really grow your money in Singapore dollar terms by investing into this, right? And given the Singapore market is so narrow, the equity market is does not give you that great returns compared to the global stock market, right? So REITs do stand out in terms of generating a consistent 7-8% total return on an annual basis, which I think in the current environment is quite attractive again. So quickly, I think, as I said earlier, the REITs that we, the underliers of this particular portfolio, fairly diversified. So we do have the logistics, industrial, the Capel DC is the data center. We do have a little bit of China exposure, which is the Mapletree North Asia Commercial Trust. So it's basically diversified, a little bit geographically, but more Singapore focused. It is, across subsectors. So you're not just exposed to, the malls and the office, which have been challenged, but at the same time, they are now, starting to come back as well, because, with phase 3 reopening in Singapore, plus vaccinations being rolled out, some of these sectors are beginning to catch up as well, right? So overall, feel pretty positive about the REITs market right now. And if you are looking to, sort of invest your funds right now, and if you're looking to diversify beyond just global stock market, and reduce your currency exposure and risks as well, I think this could be a good place to, sort of park and have some allocation to as well. Now, in terms of the offerings in our platform, we have two sub-portfolios that you can choose for the REITs offering, the REIT Plus offering. So the first one is a 100% REIT portfolio, which basically, just tracks the iEdge S-REIT Leaders Index. So if you invest into this, you're basically, in a way, investing into the Leaders Index itself. So we act as almost like an ETF to this particular index. And again, this index right now does not have any other product that tracks this index. So if you want to invest into this Leaders Index, the only platform through which you can invest into it is through the 100% REIT portfolio. Now, we also understand that there are certain audiences who might not be comfortable with 100% REIT exposure, and they want a portfolio which has an element of capital preservation. And that's where the risk managed REIT portfolio comes into play, where we combine the REIT portion of the portfolio with Singapore government bonds. And the idea of adding the Singapore government bonds is really to make sure that your overall portfolio, alongside generating you a decent amount of yield, still has some sort of downside protection built into it, or some sort of safety net built into it because of the government bonds being there, right? So again, depending on your own risk appetite and your personal situation, you can choose between the two, and you can freely switch between them as well. All right, so before moving into global and equity 100, let's take some questions in the REITs portfolio. Hayden?
Right, so Ritesh, for the REITs portfolio itself, how often can users receive their dividends from these portfolios? Are there any difference between the 100% or the risk managed one?
Right. So see, the dividends, as and when the underlying REITs give the dividends, those dividends will, get credited into your, Syfe account, and you will be able to see those dividends as a separate card, that how much dividends you have received till now, right? So as and when the REITs give out the dividends, those dividends will reflect in your Syfe account. Now, same thing applies for the risk managed REIT portfolio as well. The dividends are reflected. Now, if your question is, if you want to take the dividend out as a passive income, like if that is your goal, most of our investors who are younger, they tend to reinvest the dividend back to the portfolio. So we just show the dividend, but the dividends get reinvested back to the portfolio. But if you want to take the dividends out as a passive income, then we have a feature where you can, choose a payout mechanism, where every quarter we will see how many REITs and all the REITs that actually paid dividends, and we will aggregate the amount and then pay that dividend out to your bank account on a quarterly basis, right? So those are the two options available as well.
Right. And also, Ritesh, there are also ETFs out there that are mainly focused in Singapore REITs as well. So fundamentally, are there any differences between what we have here at Syfe as compared to those ETFs available in the market?
Yeah, no, I think that's a great question. I think I have not included the slide for that here, but generally speaking, yes. So if you compare, the 100% REIT portfolio, it's a fair thing to compare it with all the REIT ETFs that exist in the market as well. Now, the difference between our 100% REIT portfolio and the REIT ETFs is that in our case, the only fees that you pay is the Syfe management fee. And depending on, we have different tiers depending on how much you invest. So starting at 0.4% to 0.65%, that is an all-inclusive fee. There is no other fee. You don't pay any brokerage. You don't pay any rebalancing fee. Your dividends, you have the choice whether to reinvest the dividend back to your portfolio or pay it out to your bank account on a quarterly basis. Rights are automatically subscribed to, right? Now, if you compare that, with a REIT ETF, REIT ETFs, they themselves have a ETF management fee. Typically, on average, if you see across the different REIT ETFs, there are, I think, 3 REIT ETFs in the market. The expense ratio of those REIT ETFs is 0.6%. So even if you just take the expense ratio and compare it with our management fee, you will end up paying more just in expense ratio for the REIT ETF. Plus, on top of the REIT ETF management fee, you pay brokerage fee. So each time you sort of buy the REITs, you sell the REITs, you try to rebalance the REITs. If you receive a dividend, you want to reinvest the dividend, you will each time incur a brokerage cost. And the brokerage costs could be quite meaningful. Typically for Singapore REITs, on average across platforms, I've seen 0.2% one-way charge. So if you even buy and sell, you're already incurring 0.4%, right? And if there is a dividend, say even if you receive, say, $500 of dividend, there is typically a $20 minimum charge when you want to reinvest, or, you want to buy an individual REIT. So, or the REIT ETF again, right? So the point that I'm trying to make is, on average, the 100% REIT portfolio that we offer will be, a fraction of the cost of even investing into a REIT ETF, right? Because it will be 0.4% or 0.5% versus in the REIT ETF case where you pay 0.6% plus, the brokerage fee, custody charges, and other things, which can add up to almost 1%, right? So I think in terms of cost, definitely the 100% REIT portfolio will be the more cheaper option. Plus, I generally like the IHS REIT Leaders Index because it only invests into the highest quality REITs in Singapore. So that's another factor why I personally like the REITs index that we invest into as well.
Right. So maybe one last question on the REITs portfolio before we move on to the next one. So actually for 2020 has been quite an unprecedented year, even for the REITs market. So, for 2020, what were the dividends that were actually paid out for both this 100% and the REITs with risk management actually?
Sure. So I don't remember the exact numbers, but if I'm not mistaken, I think for the 100% REIT portfolio, we were, I think, close to 4.5% in terms of the dividends that came in. And for the risk managed REIT portfolio, I think it was between 3 to 3.5% for 2020. And I believe that, some of these dividends have actually come off. So if you look at, the 2019, the dividend yield was 5.1%. So it has come off to like 4.5 odd percent for last year here. And this from 4.6, it has gone down to like 3.5%. But as we move forward, I'm more optimistic that some of these, dividend yields will start to come back as well, right? Like, and again, the fact is that, like, there is much more certainty in the market now versus, what was there in 2020. And overall, we have started to live with the virus. We have started to, like, understand it better. There are vaccinations that are rolled out, more specifically for Singapore. We are already in phase 3 reopening. And also, in general, I have a pretty positive outlook on the REITs market from a 3 to 5 year horizon. I think it should be a good place to sort of continue to generate decent returns. And I think that while the dividend yields have taken a hit over last year, and it might take some hit this year as well, but it will be more of the upward trajectory, more from a medium to long term standpoint. So that seems attractive from that standpoint.
All right. Thank you, Ritesh. I think the other questions, we can also answer them along the way.
All right, great. So now I think let's look at the last bucket that we had, which is the growth bucket. And essentially in the growth bucket, we have two sub parts. The global portfolio, which is more of your portfolio where you want to balance your risk and returns, right? So you want to invest such that your money and your funds and your accumulated wealth grows in a more consistent and steady manner, versus in the equity 100, which subsequently we'll cover. You just want to maximize your return, right? So let's start with the global portfolio. I think this is a busy slide and it's a little bit complicated, but just to make you understand how our global portfolio differs from a lot of other offerings, which provide you those model portfolios where they tell you that, oh, if you are a moderate risk person, you should put 60% into equity, 40% into bond and gold. If you are a conservative person, you should put 20% into equity and rest into bond and gold. And if you're an aggressive person, you should put 80% into equity and the rest in bond and gold. The problem with those static allocation models, that's what is the top half of this presentation or the slide, which talks about the traditional asset allocation. That's how traditionally money gets invested and risk gets assessed, that for a moderate risk, this is what you should do. The fact is that when you do those kind of static asset allocation based investments, your actual risk can be all over the place, because even though you take 60% equity, the 60% equity can contribute 90% of your losses, right? And that's where I think a risk-based allocation makes a much more sense. So alongside having a diversified portfolio that you are doing by taking a combination of equity, bond, and gold, I think risk management is definitely something that you should add on to it. And that's what our strategy does in a more layman term. where essentially instead of focusing on a target asset allocation, we target a particular risk level and we quantify that risk level for you. So the way to think about our global portfolio is, you choose on day one, what is the maximum drawdown that you're willing to take on your portfolio. So if you say that, I want to invest, but I don't want my portfolio value to go down beyond say 15%, even in a worst case scenario, given that constraint, can you maximize my return? So that's what we are trying to solve for. You tell us what is the panic point for you, right? Like, what is the point after which you will actually panic and sell off your portfolio? Give us that point, and based on that, we will try to tell you what is the right asset allocation that can maximize your return. So if you look at the next slide, essentially we have 11 different risk levels on our platform, ranging from 5% to 25%. And depending on which risk level you choose, the proportion of equity, bond, and gold varies, right? And again, the point here is, rather than choosing a vague term like moderate, aggressive, conservative, you are really choosing a quantified number in terms of what the risk level that you are comfortable with, right? So very, very different from the traditional ways that you have been investing so far. And it gives you personally, it gives me a better peace of mind that, like, if a pandemic kind of a situation happens again, I know that like my portfolio will have a worst, drawdown of 15%. Whether the market goes down 20%, 30%, I don't care. The way the portfolio is structured, these guys are managing it and will, cater the allocations in a way such that the overall drawdowns can be, managed within this level, right? In terms of, the actual universe of investments, we invest into broad equities, so across asset classes as well. Bonds and gold is present too, and across geographies, right? So it's 3x diversified across asset classes, across sectors, and across geography, right? So you have your emerging market ETFs, you have your developed market ETFs, you have your international bonds, you have your corporate bonds, and you have gold as well. Before moving on to Equity 100, any questions on global, Hayden?
Right. So for the global portfolio itself, some users are wondering, what will actually trigger a change within the composition? Is it based on the event trigger, or do we do it based on pricing? So yeah,
right. I think a great question. And again, we actually, this is not an active strategy. This is not, going to react based on price movements. As I said, it's a risk-based allocation. Risk in loose terms can be translated in terms of, how uncertain the market is or how volatile the market is. What that means is every day on a portfolio basis, your combination, like, if you come in today and you choose, say, the 15% portfolio, your initial allocation might be 60% equity, 40% bond and gold. But what we will do is on a daily basis, we will measure the risk of this portfolio and see whether the risk of this portfolio is still 15%, right? As long as the risk of your overall portfolio remains within a certain corridor around the risk level that you chose. So for example, if you have chosen 15%, we will keep the portfolio allocation as is, as long as the risk level of the portfolio remains within, say, 13 to 17%. As long as it breaches the corridor of 13 to 17%, that's where a rebalance is triggered, because now it is going, too far away from your target risk level. So instead of changing the, or rebalancing based on, like, if you had 60-40 and if it moves from 60-40 to 70-30, you need to bring it back to 60-40. That's what traditional asset allocation does. In our case, we target the risk level and we manage and we watch the portfolio's risk level on a daily basis. And we create a corridor of risk around it. And if there is a breach of the portfolio's drawdown, potential drawdown going forward to be beyond the risk level that you have selected, that's when a rebalance is triggered. So it's a very, very different paradigm per se.
Right. And I think Ritesh, link up to that question, some users are curious in terms of last year, March. This was when the market took a very big hit, right? Probably the worst performing day happened in March for 2020. How did the global ARI portfolio, at 15%, perform during that time actually?
Yep. So during the pandemic, essentially the allocation of the 15% portfolio was progressively brought down from, like, I think it was 70+% equity. The equity proportion was reduced to ensure that the drawdown of the portfolio can be limited to 15%. So the overall drawdown of the portfolio was more like 12 to 13%. And then as the markets recovered, the portfolio has been adding more equity. But I mean, in terms of the way the portfolio is constructed, the fact that it lost so little, it didn't really need to recover that much. So while it was a little slow to recover back because of the higher bond allocation initially, but the fact that it lost only 12% versus the equity market fell by 30+% during the pandemic, it didn't need to recover that much, and it ended up pretty much flat overall, given that it was a moderate risk portfolio for 2020.
Right, and probably just one more question on the global RE as well. So I think this is an interesting question. So if the risk level is actually breached, though the probability is very, very low, what will actually happen to the investments? Will it be liquidated, or what actually happens there?
So the point is that we will manage the portfolio in a way that the point is not reached at all. So it is a little bit more preemptive in nature, and because we manage or we watch the portfolio's risk on a daily basis, what that means is when you're watching the portfolio's risk on a daily basis, it's basically an indicator of the future drawdowns, right? So what that means is essentially, as soon as a breach happens, it is more of an indicator that the portfolio right now, the way it is constructed, it is not lost 15%, but now it can potentially, if you keep it the same allocation, it can actually lose 20% rather than 15%. So it preemptively rebalances and brings the risk level back to the target allocation, such that when the market keeps on correcting, it doesn't need to adjust at a much later point, right? So it does so at a much more in a more preemptive manner, rather than be a late reactor per se, where after the movement has already taken place. And that's, I think, proven in terms of theory and in terms of actual research as well, where current volatility is actually a good predictor of future volatility. So if there is a continuous volatile period that has been happening over the last few very like current week or current few weeks, then there is a high probability that that volatility can continue in the future as well. And that's one of the core tenets behind which this whole risk-based portfolio has been designed.
All right, thank you, Ritesh. I think we can actually move on to Nate's portfolio as well.
All right, awesome. So let's take the last portfolio, the Equity 100. I think, again, one of our more popular portfolios, because it is very, very straightforward, and it gives you a very simple way to get exposure to the top companies across the world. So it's a pure equity portfolio. That's why it's called Equity 100. It contains 100% equity. There is no bond, there is no gold. And the idea for this portfolio is to maximize your return. And to caveat that, it's also the fact that if you are trying to maximize your return, you're obviously going to take a little bit higher risk as well, right? So what are the key highlights of the Equity 100 portfolio? So it's a pure equity portfolio. In terms of the strategy, it employs a smart beta strategy. Again, in layman terms, the idea behind a smart beta strategy is that typically when you are investing, say, for example, you can argue that I can just go and invest into an S&P 500 directly. Why do I need to use an Equity 100 portfolio? The fact is that an S&P 500 ETF is a market cap weighted portfolio. What that means is the largest market cap stock will have the highest weightage, and the smallest market cap stock will have the smallest weightage. And what that does to your portfolio is that overall, from a return standpoint, when you are trying to decompose how equities give you returns, there are basically certain underlying factors that give you returns for your equity investments. And those factors are what are called smart betas, right? Like, if you are just investing with a market cap weighted, mechanism, then you will just get a market cap or, a market return as well. But if you employ and, you can decompose these individual factors that really drive returns to the portfolio, and you weight the portfolio based on these factors rather than market cap, the risk return paradigm changes, and you can get better return with potentially smaller risk that you're taking. So that's the whole idea behind smart beta. We'll go a little bit more in terms of what these smart beta factors themselves are, but the focus, as you can see, is best risk adjusted returns. And again, as you can see, you get access to some of the top companies across the world. So as I said, smart beta strategy, again, does not mean it's an active strategy. It's a rule-based quantitative strategy. It aims to outperform a traditional market cap weighted, index or benchmark. And again, there is a thorough selection and rebalancing mechanism, and it seeks to capture risk premia in a systematic manner, right? So if you talk about the different factors that we consider, typically these are value stocks versus growth stocks, high volatility versus low volatility, and large cap versus small cap. These are, again, factors that, it's not the case that we have discovered these factors. These are factors that have been in existence for a very, very long time. And there are, multi-billion-dollar hedge funds and other asset managers that really use these factors to generate alpha for their clients. So we have just used these factors and made the product a little bit more smarter in the way the allocation to the ETFs and the equities are done, such that you get better risk-adjusted return overall. And that's where, if you see the overall weighting of the portfolio, there is, if you look at the asset allocation, while there is a market cap oriented allocation as well, because that's really the part which actually gives you market returns. But there are these smart beta components where allocations are done to ETFs such as QQQ, which is your growth exposure, ETFs such as more defensive sectors like consumer staples, healthcare, utilities, which is more of your low volatility sectors, and again low or small cap versus large cap sectors as well. So overall, if you look at the sector weightings here, there is a growth tilt, which is information technology, and that is basically through your QQQ exposure. But at the same time, to dampen the volatility and the overall risk of your portfolio, it follows more like a barbell approach, where on the other side you have these more stable sectors like consumer staples, healthcare, and utilities that continue to give you consistent returns over time without really increasing the risk of the portfolio, right? And one more thing, some people do have this question that growth and technology stocks have had a massive run up over the last couple of years. So does this make sense to still have a very high growth tilt per se? And to that question, essentially, the most recent rebalance that we had done, what that did was actually some of the technology exposure was brought down from over, I think, 30% to close to 25% right now. And even this QQQ allocation was close to 46% back in October. And once we sort of redid our analysis and everything, and we did the rebalancing in October. So this portfolio gets rebalanced every 6 months. So October was the last rebalance. And the exposure to QQQ was brought down from 46% to 30%. It was not brought down all the way to zero or very low number, because we believe on a long-term basis, growth and technology stocks are here to stay, and they will continue to give you, long-term returns because of, the way they are now entrenched into our daily lives. One more important point, I think a lot of people have this question around US withholding tax. The first thing to mention is, US withholding taxes are, applicable only on the dividends that you receive. And this is only applicable to those ETFs that are domiciled in the US, right? And invested in the US stock markets, right? So first point to note is only applicable to dividends, not on capital gains. So if you are investing $100, you get $1 of dividend, your tax implication is only on that $1. The other $9, if your $100 grows to $110, that $10 of capital appreciation is not subjected to any taxes. So that's the way to understand this. Now, in our case, we take a very sort of data-driven approach in terms of switching to some of the non-US listed ETFs, such that you don't have this high dividend tax applicable to you as well. So while dividend withholding tax itself is really low, because it is only applicable to the dividend portion of the portfolio, and given that this is an equity portfolio, the dividend is typically 1 to 1.5%, right, which is really low. And even on top of that, what we do is, for some ETFs like S&P 500, instead of investing into the US listed ETF, we invest into the Irish domiciled ETF, where instead of 30% withholding tax, you only pay 15% withholding tax. And this is, again, only on the dividends. But on the other side, we keep using the US denominated ETFs, or the US listed ETFs, in cases where it actually doesn't make sense to switch to the UCITS one. Because, for example, if you look at the NASDAQ 100, the QQQ, there is a European version of it available as well, which has lower withholding tax, but the management fee is higher. So when you do the overall calculation, it actually makes sense to still invest into the US listed QQQ rather than EQQQ, because overall, even after accounting for the dividend withholding tax, the QQQ will save you more money in terms of lower management fee. So we have done all this homework for you, and we make sure that alongside just like superficially looking at dividend withholding tax, we also look at the management fee, the spreads, the liquidity of the underlying ETFs themselves too. All right, so before moving into the next section, I think we have covered all our portfolios now. So I think we are close to 8 p.m. So happy to take questions in terms of all the different portfolios that we discussed. So let me just quickly go to the slide where essentially we have all the 3 portfolios, and the purpose of the 3 portfolios listed as well. So Hayden, any questions so far?
Right. So actually for the equity 100 and also our other portfolios, it comprises with a lot of different ETFs. So one of the users you have asked that, some of the composition is actually below 2%, below 3%. So does having so many different composition in a low percentage affect the cost within managing these funds? And are there any costs imposed on them having so many different things within one portfolio?
Right. So see, I think again, the fact is that on Syfe platform, you don't pay any brokerage fee. You don't pay for any transactions. You can put any amount of money and in any proportion, and we will buy these underlying, ETFs for you. So from a client standpoint, there is no cost involved. So we absorb all brokerage cost, rebalancing cost, dividend reinvestment cost, and we trade these each individual ETFs in size, right? Because on any given day, there are multiple investors that come, and the amount of money that gets poured into each individual ETF could be still sizable. So we are able to trade them in size as well. Now, with respect to the question that small allocations being done to certain ETFs, that's again part of the whole investment optimization process that, while on the like superficial level, it looks like, very small allocations, but each one of these are really the part, each one of them, they play a part in terms of, improving your overall risk-adjusted returns, right? So they definitely have a role to play, and that's why we have chosen to, invest into them. And going forward, it is always possible that some of these percentages can change and vary as well, right? So I think I hope the 2 parts answer the question that was asked in terms of why some of these low percentage ETFs are used, and number 2, if there are any cost implications to the clients. So, from a cost standpoint, there is no implication to you.
Right. And also, Ritesh, I think some users are also curious that, for equity 100, why do we use ETFs as an underlying asset instead of, picking particular stocks in that sense?
Yeah, no, so I think this is again part of our overall, I think principle that we are, we firmly believe that essentially active management doesn't really or necessarily mean that you will really outperform the market, right? The fact is that if you go back in history and look at the last 15 years, almost 90% of active managers, they actually end up underperforming the benchmarks or the indices, right? So there is no point, according to us, trying to, stock pick and trying to implement a, smart, fundamental based strategy per se. What we have gone and done is basically just redo the allocation within the equity world, right? Like, in terms of picking the most liquid ETFs, the most easy way for you to sort of invest into, the equity market in a broad-based manner on a global basis. And that is most easily implemented via an ETF, via a passive instrument like it. And just to add a little bit more, value to the overall portfolio, rather than just blindly using these ETFs and, picking numbers in terms of allocation to these different ETFs, we have used this smart beta strategy. And again, this is very research driven. This is very, theory driven. This is very rules based. It is not like taking bets on the market. So what that does is essentially you take a more pragmatic approach and you are investing into the equity world in a more optimized manner without human emotions and biases and all of those. And on a long-term basis, I don't have I think I have the returns on a long-term basis for the equity 100 portfolio, but it basically results in a much better risk-adjusted return from a client standpoint, right? So if you look at this particular slide, I think it demonstrates how this equity 100 portfolio really helps you generate a better risk-adjusted return, because on an annual basis, you look at this side, you get a double-digit return, and standard deviation, which is typically a measure of risk, is actually amongst the lowest if you compare with a broad-based index like S&P 500 or MSCI World, right? So essentially, what you're trying to do is generate some sort of value out of this equity 100 portfolio beyond the market cap oriented benchmarks, and do it at much lesser risk level that the broader indices take, right? So overall Sharpe ratio is amongst the highest amongst all of these three offerings. And it has been able to generate these returns on a consistent basis. Last year, 2020 equity 100 was 23% up. So that's the year to date return for that portfolio versus S&P 500, which was 18% up. Right? So that's the way I would think about the equity 100 portfolio.
Right. And also, I think on top of the equity 100 portfolio, in terms of investing within them, is there a particular time that we should be looking at, or, on an overall, we should be doing it more on a consistent basis, actually?
Right. So I think it brings us to a good topic. I think let's go into it in interest of time as well, that we heavily espouse a core satellite framework of investing. And we firmly believe that rather than trying to time the market, you should really, invest with time in the market and, invest in a more disciplined and consistent basis. So that should be the basis of your investments rather than, just trying to make a quick, buck out of your investments by taking some speculative, positions per se. So now again, if you look at the two things that we talked about, right, in terms of purpose-driven investments, goal-based investments, we've talked about all the different portfolios that we have on offer. But I think, once you have the purposes and the objectives cleared out, you still have that question that how do I allocate between these different strategies, right? And that's where a core satellite approach could be very helpful to a very again, simple manner. If you want to get started, you can think of a core portfolio to be something which is a diversified portfolio across asset classes. So a global portfolio, which is across equity, bond, and gold, can be considered as a core portfolio, versus satellites could be those portfolios which are high risk, high return. So potentially 100% REIT or 100% equity portfolio could be considered satellites. Now, again, if you are very particular of just generating a particular, a passive income, then even a REIT portfolio can be considered as a core. But I think the broad level idea is that think when you are trying to invest, what is your core, what is your satellite, and then sort of make appropriate allocations as the need be. This is another case study of one of our clients, essentially, who's 40 years old, wants to retire at 60. And this basically combines the aspect of the purpose of the investment or the objective of the investment and the core satellite approach as well, right? So if you look at this particular, client, his goals are retirement. His goal includes children's education. His goal also includes buying a house. Now, for each one of these goals, the way to think about the different portfolios and to incorporate these different portfolios, you can really see how the money can be then allocated across the different, offerings that we have to cater to all these different goals, as well as implement a more core satellite approach to investing, right? So for retirement, for example, while the person would want to have a core allocation, which is a global portfolio, the person also, because he's investing for a 20-year horizon, wants to participate in the market, and that's where the equity 100 portfolio allocation comes into play. And then at the same time, in 20 years' time, he would really want to generate some sort of a passive income. So he starts, at age 40 to invest into this Reits portfolio, such that by age 60, the portfolio grows big enough to generate him a passive income, right? And similarly, children's education, because it's a little bit lower time horizon, the global portfolio has been chosen, but at a lesser downside risk as well, right? And similarly for the house payment, it's a Singapore dollar denominated, payment that the person needs to do. So for that, he's investing into the REITs portfolio, and the investment time horizon is 5 years in this case, right? So I think depending on what you're trying to achieve and what your goals are, you can really apply a core satellite framework to your investing, alongside the whole aspect of what is the objective, what am I really trying to solve by doing these investments, right? So, and categorize all of these different options that are available to you accordingly too. Right. So I hope this helps clients to get a better perspective of how to think about the different portfolios and how to allocate between them. So maybe I pause here a bit again because I'm sure like there would be some questions on this as well, Hayden.
So actually, in terms of that allocation wise, how should investors themselves be placing within this kind of core and satellite? Is it more of a lump sum basis or monthly basis? How should this be actually apportioned across?
Right. I think that's a good question. In general, see, I think as an individual and as an investor, there are really two things or three things that we're trying to optimize, right? Number one is, your emergency funds. Like, you should make sure that you have sufficient emergency funds and that is kept liquid and safe and all the time, like, invested into a very, it gives you a decent amount of return for the cash that is kept liquid and safe, right? So partly that safe aspect of it, you can keep it in the bank, keep it into some high interest, sort of accounts, or you can keep it into our cashless portfolio. Beyond that, if you have sufficient money safeguarded for your emergency funds, ideally you should be looking to invest all the rest of the money that is lying in the bank account on an idle basis, right? Because over time, each one of us as professionals, we would have saved and accumulated certain wealth. And if that wealth, beyond our emergency funds is just lying in the bank account, it's actually losing money because inflation is going to eat away that, the money that is just sitting idle. So ideally, from a lump sum standpoint, you should begin by thinking, what is the surplus cash that I have in my bank account? And then think through the different goals that you have. And then start off with, maybe a core satellite approach to investing in terms of thinking through, how do I get started with this lump sum amount? So this particular example talks more from a lump sum standpoint, that this person had a lump sum of $100,000, which is the surplus that he has, and he wants to invest and grow it for 20 years, right? So the lump sum should be thought through more from the standpoint of what is the surplus cash that you right now have, which is lying idle, right? That's number one. The second part that needs to be optimized is, again, most of us are professionals who are working on a monthly basis. We generate a certain amount of income and we generate a certain amount of savings. The monthly savings is what should be used to sort of contribute to these portfolios and grow these portfolios over time as well. And depending on which goal is more important to you, and what is the portfolio that you like more, or you have bias to, or you want to grow more, you can accordingly channel a higher percentage of your monthly savings into those portfolios, right? So again, ideally, if you want to make your money work hardest for you, first optimize your surplus cash that is lying idle. After that, optimize the monthly savings that you're generating, because again, if the monthly savings goes back to your bank account, it's basically just gonna go and sit idle, because you've already saved your emergency funds. That is already the safety net that you have built in. So all the rest should actually go to purpose-driven investments and objective-based investments per se, whether short-term, medium-term, long-term. But the idea is you should look to deploy them.
All right. So thank you, Ritesh. I think probably we can take on one last question. I think this will be across all our portfolios as well. Do we actually have a particular take on the ESG companies within what we choose in our portfolios, or we have yet to incorporate this at the moment?
So I think right now we have not specifically looked at ESG and incorporated it into our portfolios, but I think this is an important topic, and a lot of clients are becoming increasingly sort of they would want to think on ESG in a more serious manner. And previously, ESG investments was regarded more of a way for clients to be investing in a more socially, more responsible manner overall. But what has been observed, I think, based on recent research, is that ESG actually can also drive performance, and it can actually give you better performance than non-ESG component-based investments. So at our stage, and right now where we are still in the research mode and trying to figure out what is the best way for us to incorporate ESG and related attributes into our portfolios as well. So give us a while. We are definitely thinking about it. These are important things, top on our mind as well. Right now, there is it is not incorporated in our portfolios, but yes, we will look into it deeper, and rest assured something will come up soon.
Right. Thank you, Ritesh. So I think one more question that just came in. I think this is pertaining to our team as well. So I think we could answer this. For the wealth experts within Syfe, when users schedule a call with us, what can they actually usually expect out of this? Or do we plan for them their goals, or do we kind of give them ideas for them to make their choices on their own then?
Yeah, so it's see, I think at the end of the day, the digital platform is there for you to sort of do everything by yourself. But at the same time, we just need a little bit of a validation in terms of what we are trying to achieve, and are we thinking on the right lines? And you want to understand the products a little bit better. That's why the wealth experts come into play, because we can help you out in terms of thinking through, like all the slides that we went through. Basically talked about objective-based investments, purpose-driven investments, and that is really what we keep reiterating through our, sessions as well. And I think a lot of times people have misconceptions, or they, do not understand certain portfolios and the objective and the purpose of those investments. And that's where I think we can help them and guide them through in terms of making better choices, right? Because a lot of clients might be sophisticated and they know what they're doing, but believe me, there are a lot of clients who have no clue in terms of what these portfolios are. And we don't want clients to just invest blindly, right? Like we want to be very objective, and we want to be sort of helping them out in a very non-biased manner. So our experts are not incentivized, we are not paid commissions. We are just there to help you out in terms of making better choices.
Right. Thank you, Ritesh. I think that's all the questions we have, and we have answered all of them. So thank you.
All right, awesome. So how to get started, right? So really, really simple. Our platform is available online through the website, www.syfe.com. We are also available on the Google app, Google Play Store, and the Apple App Store. It's a really sleek application. You can go and download our app. You can get onboarded literally in a 3-step process. Like you go through a risk analyzer. There is a get started button. You answer a bunch of questions. Once you answer them, you can get yourself onboarded using my info. And within, I think, 5 to 10 minutes, you are ready and your account is verified. Once your account is verified, it is very easy for you to choose different portfolios and sort of transfer funds to those portfolios. And as soon as we receive our money into each one of those different portfolios, we will go ahead and invest them accordingly. And very easy to monitor. We show each and everything that you would want to see in your platform and in your investments with respect to transparency. You will be able to see the underlying holdings, the transactions that has happened in your accounts, the current market value, the profits, losses, or even the fees, right? Like to the T that you can really calculate them back and check that we really charge X amount of fees per se, right? Now, coming to fees, I think very important to highlight that number one, our cash portfolio is free. There is zero management fee. So it's an absolutely free product. We don't make any money on the cash plus portfolio. But at the same time, we don't include this portfolio when calculating the actual fees that you pay for our investment portfolios. So the investment portfolios are basically your global, the equity 100 and the REIT plus portfolios. When you invest into any of the three, if the total investment size, the sum of the investments across these three portfolios, if that is basically below $20,000, then the annual management fee is 0.65%. If the total is above $20,000 but less than 100,000, then the annual management fee is 0.5%. If it is above 100,000, then it is 0.4%. And depending on which tier you fall under, you get different levels of access to our expert team as well, right? And the good news is there is no other hidden charges. There is no trading fee, no transaction charges, no end at any point of time. All the rebalancings are done free of cost. Your dividends are reinvested at no extra cost as well. And more specifically for just the ETF-based portfolios, which is Equity 100 and the Global ARI, the ETF management fee are supposed to be like really, really low, because we invest into some of the most liquid and highest of ETFs. So the overall cost that you pay by investing into our portfolios is really, really minimal. compared to, all the different things that you will observe in the market. For the kind of value that you're getting from the platform, I think, it's not a bad thing to sort of, pay a small management fee of 0.4, 0.5, or 0.65%. Now, again, comparing with DIY investments, I think we covered it a little bit earlier as well. On our platform, there is no minimum, there is no requirement of setting up brokerage accounts or CDP accounts. In terms of setting up the portfolio and account, it's literally, on the click. So you can onboard using MyInfo in minutes versus, some of the DIY platforms where there are multiple days that it takes for to get onboarded. Risk management is, sort of incorporated versus in DIY, you have to do it by yourself. There is auto rebalance, reoptimization, dividends are automatically reinvested. There is no brokerage fee. So again, it's an all-inclusive kind of a platform. The only fee that you need to think about is, these management fee, and you don't have any other, hidden fees in terms of, sort of entry, exit, or trading, or, switching costs and stuff like that. So yes, you can even switch between different portfolios without any charges. And last but not the least, I do head the investment advisory team, but these are my superstars. So Melvin, Hayden, and Jajwin. So please do reach out to us on the Syfe website, www.syfe.com. There is an advisory tab. There is a very easy way for you to set up a call with us. So do reach out to us, and if we can help you out in terms of making better decisions, it will be our pleasure as well. Now, a few upcoming webinars. So we have a deep dive into our investment strategy. I think we, covered a little bit in terms of, what our different investment strategies are with respect to our global portfolio as well as the equity 100. But this is really the, webinar that you should attend if you want to get a very deep dive, information in terms of how we manage your money. So that's on 28th of Jan. And before that, our latest offering, again, Cash Plus. We will do another session to help you understand the nitty-gritties of investing into the cashless offering. And again, why this is so attractive given the current low interest rates that you are seeing in the bank accounts. Also a quick promo. So, for all our viewers today, if you have joined in, there is a quick feedback form that you will need to fill and post that feedback form. You will get a promo code. So if you apply it, the first 6 months management fee will be waived off for you. So that will be valid for up to the first $30,000 that you invest as well. So do, sort of take a snapshot of this QR code and please fill up the feedback form. If you have some things that we were not able to cover during the session, please mention them in the feedback form as well, and we'll definitely try and get back to you. All right, so I think we covered most of the questions. We are 8:20 right now. So Hayden, maybe a couple more questions before we wrap up.
Right. So we have actually answered all the questions previously, and as you were explaining the fees and whatnot, we have actually answered them online as well. So I think we have cleared them all.
Awesome. This is great. Then I guess we will wrap it up in this case. And again, thank you everyone for joining us today. Hope the session was useful. And again, please fill up the Q&A. If you have further questions, do reach out to our wealth expert team as well. Thank you, everyone. Have a good night.
Thank you, Ritesh. Bye-bye.
Bye.